Thank you all. I'm flattered that 50% of the population of Ottawa has come to see me today. Good, huh? Good. So I'm going to talk about why the financial crisis happened, what's happened since, and I'll give some predictions for the future of the financial services sector in the United States. And then when I'm done, I'll take questions till you're all exhausted. How's that? So before I start, I'll answer the question that I always get, which is, how involved was I with the movie? Now, with respect to the book, of course, I was very involved. Michael Lewis interviewed me about a dozen times. But with respect to the movie, I really had no involvement whatsoever. In fact, my contribution can literally be confined to one word. And the origin of that word is my family and I were invited to watch a scene being filmed in New York. And the scene is Steve Carell is walking on the streets of Manhattan, and he's talking on his cell phone to his wife, my wife, Marissa Tomei. That never gets old. It never gets old. And he's talking, and he's talking, and he's talking, and he's talking, and finally, he's about to hang up, and he hails a cab, and they have a cab pull up, and one of the extras runs past him to steal the cab. And the way the script was originally written, Steve Carell turns to this extra and says, quote, "Hey, that's my cab, asshole, cut." And then Steve Carell goes over to talk to Adam McKay, who's the author of the script and also the director. And me being me, I mosey on over and I say, not that this ever actually happened, but if it were me, I think I would have said schmuck. And schmuck's in the movie. So the coda of the story, which is sort of amusing, is after watching the scene being filmed about 30 times, my wife turned to me and said, there's something been bothering me about this scene all day. And I said, really, what's that? She said, there's no way you would ever speak to me for that long on the phone. And it's true, I do terrible phone, terrible. So, why the financial crisis happened? Well, you need three things for a financial crisis. Number one, you need too much leverage. Number two, you need a very big asset class that blows up. And number three, you need important large companies, banks, to actually own the asset class. So you need all three. Unfortunately for planet Earth, we had all three in 2007 and 2008. So how'd we get there? Well, let's start with the leverage. So between 1997 and 2007, leverage in the financial system more than tripled. To put some numbers around it with respect to one company, Citigroup, which we could all call the poster child for the financial crisis, in 2002, Citigroup's assets reached $1 trillion, and on that day, the company was levered 22 to 1. It had taken Citigroup almost 100 years to get to $1 trillion in assets. And 5 years later, in June of 2007, just before the crisis started, $1 trillion had grown to $2 trillion, and 22 to 1 had become 35 to 1 in a mere 5 years. So why was leverage up so much? Well, there are really two reasons. One is with the role to risk-weighted assets. The financial system developed a methodology to measure both capital and risk by creating what's called the risk weighting system, where every asset on the balance sheet gets a risk weighting. It was a flawed system, remains a flawed system. Nothing is perfect. It was horribly abused. It relied on rating agencies with respect to anything rated AAA, gets a low risk weighting. It relied on the models of the banks themselves to grade themselves. It was also very backward looking because it looked at historical loss rates, and if something had a very low loss rate historically, it would get a low risk weighting, and it never took into account the idea that underwriting standards can change, and that something historically that had a low level of losses, if the underwriting goes crazy, could have a very high level of losses, and something that has a low risk weighting really should have had a much higher risk weighting, and these are all the things that happened. The result was that, banks all over the world always viewed their capital on a risk-weighted basis, not on an absolute basis. So that by the time the crisis happened, leverage had gone up 3 to 4 times. But the way the banks look at their capital ratios on a risk-weighted basis, over the same period, their leverage ratios were flat. So the people who ran these institutions literally thought that they were no more levered than they had been 10 years before, whereas in fact they were levered 3 to 4 times more. That's one reason. The other reason, which you'll never read in any economic textbook, is psychological. And that has to do with the fact that the people who grew up in the 90s and the 2000s who ran these companies had a very, very odd experience. They made more money every single year. It's a very heady sort of thing to happen to anybody. Now, the reason why they were making more money every single year is that their firms were making more money every single year. But their firms were making more money every single year because their firms were becoming more levered every single year. And really what was happening was they mistook leverage for genius. Write that down. I wrote that. It's freaking awesome. So they mistook leverage for genius. And if you had gone to the CEO of any one of these companies in 2006, let's say, and said to them, listen, the entire basis, the entire paradigm on which your career is based on is wrong, their response would have been, listen, I made $50 million a year. What'd you make, asshole? Literally, because that's what they said to me. So leverage in the financial system was up 3 to 4 times, and really almost nobody noticed, except like people like me, who, nobody consulted me, so it was like toiling in obscurity. So let's talk about subprime mortgages. This is an asset class that people almost don't even remember anymore what it was all about. So let me describe to you what the loan was, because most people don't even remember. So the typical subprime mortgage was what was then nicknamed a 228 or a 327, which meant that the customer was given a teaser rate for either 2 years or 3 years, and then was repriced upward for the next 27 or 28 years. And to make the math very simple, between 2002 and the summer of 2007, most subprime mortgages that were originated in the United States had a teaser rate of roughly 3%, and then would reprice at 9%. So 3%, 9%. This is what goes on south of the border. You people don't know this. You're Canadians. You're all nice and polite. It gets me very nervous talking to you people. So the industry, I'm going to use a very technical term here, the industry underwrote the loans to the teaser rate. So what does that mean? Well, before I explain what that means, let me teach you a little lesson about the consumer finance industry in the United States. Consumer finance industry in the United States is very good at creating slogans and euphemisms to disguise the fact that they're about to rip your face off. So for example, hence the wonderful slogan, free checking. When I was growing up and went to the bank for the first time, I had to pay to have a checking account in my bank. Then a company in Minneapolis called TCF Financial, which is a bank, created the free checking model, and it swept the industry by storm. So what does free checking really mean? Free checking means your checks are free. There's no cost to you on the front end, but on the back end, if you make any mistakes, if you're late on your payment, if you go over your limit, you get your face ripped off. So why do you call it free checking? Well, imagine the advertising problem. Let's imagine 2 different advertising campaigns. Number 1, come to Bank X where you get free checking, versus come to Bank X where we're going to rip your face off. Where would you bank? You'd bank with free checking, hence they call it free checking. So what does it mean to underwrite to the teaser rate? It means that the underwriters, the lenders, all of whom were specialty finance companies who don't exist anymore, knew when they underwrote the loan that the customer could only afford to pay 3%. That customer could not afford to pay 9%. Now, why would you make a loan that has a teaser rate of 3% for 2 to 3 years when you know your customer can't afford to pay the rate that he or she is going to have to pay in 2 or 3 years? Well, here's where one of the lessons of the crisis is that incentives trump ethics every time. The people who originated the loans were paid 3 to 4 points up front to originate them. And as the customer got closer to his or her reset date, they would start to panic because they knew they couldn't afford to pay 9%. So they would go back to the originator and refinance their mortgage, pay another 3 to 4 points up front to keep the 3%, and do it all over again. So from the originator's perspective, this was a gravy train because I'm re-originating the same customer every 3 to 4 years. From a Wall Street perspective, they bought the loans from the originators, packaged them, securitized them, sold the loans to investors. Everybody on Wall Street who was part of this process got paid on volume, and because the customers now had to refi, the securitizations would basically disappear after 2 to 3 years, and when they got to do this all over again every 2 to 3 years. So everybody in the chain was making money. From a societal perspective, however, this is a calamity, or was a calamity, because the customers, the consumer, is never paying off his mortgage. Every 2 to 3 years, he or she is refinancing and getting charged 3 to 4 points and never paying off their principal. So from a societal perspective, this is really a disaster, but from a profitability perspective, it was wonderful. But if you took a step back and you said to yourself, you know, if anything were to happen that were to cause this refinancing story to end, everybody would get repriced up to 9, everybody would default, and that would be horrendous. So that's what I was looking for. So, you know, people always say, oh, you're so smart, you figured this out. You know, it's not really the case. I'm confessing. Everybody's a product of their own history. In the 90s, I was a sell-side analyst at Oppenheimer, and I covered one of the things that I did cover was the first generation of subprime mortgage companies. And for various reasons, which we don't have to go into, in 1998, 90% of the industry went bankrupt. Now, this was a very odd experience because down the hall from me was Henry Blodgett, and he was covering Amazon. And Henry was going out every day talking about how Amazon's going to 400, and I got 10 companies that just went bankrupt. You don't forget that. So in 2002, when the second generation of subprime mortgage companies went public, I noticed something very interesting. The CEOs of the second generation were the same CEOs of the first generation. They just changed the name. And I realized what I was witnessing was the same play. I knew how it ended the first time in tragedy, that this was going to be a play in 3 acts. And it was only a question of when's Act 3. So there were 2 things that told me that it was the beginning of Act 3. The first was on May 8th, 2006 at 7:10 in the morning. Anybody want to know what that is? On that day, Golden West sold to Wachovia. Now, Golden West was the largest California thrift. It was run by a married couple, Herb and Marion Sandler. My father's best friend had been Herb Sandler's older brother. So the Sandlers kind of knew me in diapers, so I kind of paid attention to what they did. They were the best mortgage underwriters in the United States, and on May 8th, they sold the company. And I knew there's no way the Sandlers are selling their company unless something really serious is wrong. And then the second thing that happened was that by the time of the summer of 2006, it was very clear that there was something seriously wrong with underwriting in subprime. And let me explain why that's so. You know, here's how underwriters don't think like normal human beings. An underwriter writes loans to a risk-adjusted yield, which is the yield minus the expected losses. And in 2002, 3, and 4, the delinquencies and expected losses on subprime mortgages came in much, much lower than expected, which meant that the losses were going to come in much, much lower than expected. Now, the underwriters didn't pat themselves on the back and say, good job. What they said to themselves was, I'm too tight, because I was estimating losses of something like 7%, and they're coming in at 3. So if I loosen my underwriting standards, I could double or triple my volume, achieve the expected losses that I was anticipating to begin with, and make a lot more money. Now, what they didn't realize at the time was that the reason why the delinquencies were coming in so low is that the industry had brought into the housing market millions of people who couldn't afford homes before. And so housing prices started to skyrocket. People don't go delinquent on their mortgages when their housing prices are skyrocketing. But the underwriters didn't think of it that way. They thought of that I'm too tight. And so every year in the United States, underwriting standards deteriorated and deteriorated and deteriorated until by early 2006, the underwriting standards in the United States had become, can you breathe? Because if you can breathe, we will give you a mortgage. I am not exaggerating. Breathe, give you a mortgage. So by the summer of 2006, what had happened was we had maximum deterioration underwriting standards at maximum high housing prices. It's a recipe for disaster. And I remember, you know, meeting with the head of securitization research at one of the big Wall Street firms, talking about what was going on, and he said, I'm not worried about this. And I said, why? And he said, because housing prices have never gone down on a national basis in the United States since World War II. And I said to him, is that like a law of physics, or are you smoking dope? The meeting was sort of over after that. So by the summer of 2006, the loans that had been originated in early 2006 and securitized by the spring of 2006 began to show very high levels of early stage delinquencies. Now, if we lived in a just and rational world, we don't, by the way, but if we did, then what would have happened was Wall Street would have said, you know what, there's something wrong with the asset class. We have to tighten some underwriting standards and originate less and go from there. But the problem is, and here again, this is where incentives trump ethics. Everybody in the business was paid on volume, and nobody wants to make less than they made the year before. So they, instead of originating less, they originated more. I began shorting subprime mortgages in the late fall of 2006, and I kept shorting them through really the summer of 2007. By August of 2007, it was very clear to anybody, even with no brain, that there was something seriously wrong with the asset class, and you could see a panic begin to emerge in the mortgage market. And I saw this in sort of an amusing way. In August, my family and I, we used to go to Nantucket for 2 weeks every summer. And in the second week, my wife and I were walking in town, and she turns to me and she says, "Where'd all the men go?" And I said, "They went home to watch the end." So what happened was, because the data was getting so bad, the end user, the investors, stop buying the paper. And if the investors stop buying the paper, Wall Street can't sell it to them. And if Wall Street can't sell it to them, they're not going to buy it from the originators. And if they're not going to buy it from the originators aren't going to originate it. And if the originators aren't going to originate it, then they're not going to refi people. And if they're not going to refi people, everybody's going to get repriced from 3% to 9%. And what was really bad credit quality became horrendous credit quality. And that ended the subprime. That began the subprime crisis. You know, it's very interesting that our regulators didn't see any of this coming. We can thank Alan Greenspan for that, who allowed the shadow banking system to grow without any supervision whatsoever, which was why everything that happened in the crisis seemed to be a surprise to the regulators in the United States. You know, I remember in 2007 and early 2008, on several occasions, Chairman Bernanke and Secretary Paulson made speeches where they both said that we'd be watching this on TV, and they would say, you know, the subprime crisis is contained, to which I would turn to one of my partners and say, yeah, it's contained to planet Earth. So, and now we come to the third part of the story, which is Wall Street held the paper. So the obvious question is, if the guys who are in Wall Street are supposedly the smartest people in the room, why were they left holding the bag? Which there's not an obvious answer to that question, in the sense that it also goes against their business model, because their business model is to buy it and sell it, not buy it and keep it. So why did they buy it and keep it? Well, there are two answers to that question. So the first answer is, and here's a dirty little secret about Wall Street, which you people in Canada, because you're so polite, don't know, is that not everybody who runs a Wall Street firm is smart. Shocking. Now, I actually learned this in sort of an amusing way. I remember it was 2006. I was at a luncheon of a sell-side analyst who was hosting the chairman of one of the largest institutions in the United States. I used to name it, but my chief compliance officer, my wife, won't let me do that anymore. And I'm sitting listening to the chairman of this firm, and I'm eating lunch, and all of a sudden a light bulb goes off in my head, and I have an epiphany, and I say to myself, oh my God, he's dumb. And this incredible insight served me very well, because in 2008, this idiot bought a company that was the equivalent of buying the bubonic plague. And I remember a friend of mine who ran a different hedge fund that's also specialized in financials called me up and said, he was short, so it didn't bother him that this happened, but he thought maybe this guy knows something I don't know. But he was so crazy, he was stuttering. He said, Steve, that's crazy. Why would he do that? And I said, he's dumb. And he said, wow, that's a very interesting insight. You could be right. And then 6 months later, this moron bought something else that was like buying the bubonic plague part 2. And my friend called me up. He said, God damn, you were right. He really is an idiot. So that's one reason. The second reason, and here again we get to incentives trump ethics every time. You know, as the years rolled on, it did become somewhat more difficult to find investors to buy this paper, especially as the credit started to get a little worse. So now, again, if we lived in a rational world, you would just create less of it. But again, everybody in this chain is paid on volume, so the people who ran the securitization desks convinced their own firms to hold the paper. After all, it was rated AAA. How bad could it be? And that's why when the losses started to mount, Wall Street was holding the paper. And you know, I thought that maybe we would escape this, because in early 2008, I thought, you know, maybe we still have time. I remember I had a meeting with the head of risk management at one of the big Wall Street firms. Again, I won't name any names, but it wouldn't matter what the name is, because I could have had this meeting with any head of risk management, any firm, and would have had the same result. And we had the following conversation. I said to him, it's always a him, that there's a lesson there somewhere. We could talk about that later. But it's always a him. And I said to him, dude, you got to delever the balance sheet because Armageddon's coming. That's exactly what I said. And he looks at me and he says, yeah, I hear you, but here at our firm, we got a pretty liquid balance sheet. We could be much more levered than a bank. I think his firm was levered about 37 to 1 at that point. And back then there was a regional bank in Detroit called Nat City, which had a lot of subprime mortgages on its balance sheet for various reasons. And in February of '08, people were talking about it. And I said to him, do you know what happens if Nat City goes down? And he says, no, what happens? I said, nothing. The regulators come in, they take over the bank, they make the depositors whole, they sell off the bank, government takes a loss, end of story. Do you know what happens if your firm goes down? Planet Earth burns. Who should be more levered? And he looked at me like I was talking in ancient Greek. What I was talking about was so outside his paradigm, he couldn't even understand what I was saying. And I realized then, 1 month before Bear Stearns, we're going down the rabbit hole because he doesn't even understand what I'm talking about. So, and that's where we went, down the rabbit hole. And the question I get all the time is, do we really have to bail them out? And the answer to that is, as distasteful as it was, and it really was distasteful, the answer is yes. And I think the answer is yes, because let me describe to you what I think would have happened if the answer had been no. So, of course, Lehman went down, but then AIG would have gone down. And AIG was ground zero derivatives, and they would have taken a whole bunch of firms down with them, like Morgan Stanley, Bank of America, and Goldman Sachs, et cetera. GE would have had to have filed for bankruptcy because it was really a financial services company. Any industrial company like Caterpillar, which had a large commercial paper presence, would have also probably have filed for bankruptcy. And the Great Recession would have become the Great Depression, and 10% unemployment would have become 30% unemployment, and it would have been a disaster. So as distasteful as it was, I think the regulators finally did the right thing. So what's happened since? Actually quite a lot. Pre-crisis, the regulators in the United States had two jobs. Job one was to protect the safety and soundness of the banking system, and job two was to protect consumers from bad actors in the financial services sector. With respect to job one, safety and soundness, our regulators did about as bad a job as anybody's ever did in the history of mankind. With respect to job two, protection of the consumer, they didn't even care. So Dodd-Frank split the responsibilities. They got rid of the alphabet soup of regulators that we had and essentially gave the job of safety and soundness to the Fed. And consumer protection is in the hands of the Consumer Financial Protection Bureau, the CFPB. Now, I think the CFPB is a great addition to our regulatory apparatus. I think it's done a pretty good job. Not perfect, but a pretty good job. I wouldn't change a thing. That's obviously not agreed with the current administration and is a pretty minority position on Wall Street, but then again, I've been there before. With respect to safety and soundness, I can say the Fed has actually done a very, very good job. Leverage has been crushed. Risk has been reduced enormously. Getting back to Citigroup, which used to be levered 35 to 1, it's now levered 10 to 1. Credit quality used to be a disaster, now it's pristine. So I could say really for the first time in my career, the bank regulators in the United States have actually done something very, very good. So let me finish up by just discussing what I think is going to happen under this new administration. You hear a lot of rhetoric about changing Dodd-Frank, eliminating Dodd-Frank, obliterating Dodd-Frank, maybe bringing back Glass-Steagall or a modern-day version of Glass-Steagall. It's all rhetoric, none of it's going to happen. You need 60 votes in the United States Senate to get any of that done. I don't think there's 40 votes in the United States Senate to get any of that done. So rhetoric aside, that's not where the game is going to be played. The game is going to be played on the regulatory basis. Dodd-Frank created a position in the Fed called Vice Chairman in charge of bank supervision. President Obama never appointed anyone to the post, but the job was held de facto for the last 6 years by Governor Daniel Tarullo, who, in my view, has done an incredible job in what he was supposed to do. He resigned, and his last day was April 7th. The president is on the verge of appointing someone new, and I can guarantee 2 things to you about that person. Number 1, his name is not Daniel Tarullo, and number 2, his name is not Steve Eisman. What's going to happen is the Fed regulates the banks through the annual stress test. Think of it as the hardest test you ever took when you were in college, on the hardest curve you ever had to operate under. That's the stress test. Starting in 2018, we're getting an easier test. And so as a result, you're going to see banks start to buy back more stock. They'll start to relever. We're never going back to 35-1, but we could go back to 14-1. The Volcker rule, here's my favorite word, will be reinterpreted, so it's not as strict as it is, and the profitability of the industry will start to go up. That's where we're going. It'll take a bunch of years to get there. Hopefully we don't get anywhere close to where we were, but we're certainly going to be moving under this administration, rightly or wrongly, in that direction. So I've taken a lot of your time, and I thank you for hosting me, and I'd be happy to take as many questions as time is allotted. Thank you. Questions?
Got questions for the fellow.
Steve, did you make some money?
Did I make some money when?
Here's the short.
Yes, I did make some money. Yes. Whoa, sorry. Yeah, you got him?
Testing 1. Yep.
Yeah.
Steve, just a question about, so you said there's 3 things that are needed for a crisis, right? And the third one was that Wall Street needs to be holding the bag when it actually happens. But what do you think of the potential private debt bubble that has been created since 2008 with the interest earned reserves and banks refusing to basically lend to the small and medium-sized enterprises? What if there is a bubble that potentially could pop where it doesn't just have Wall Street holding the bag, but it actually makes Wall Street profit from it, right? If the smaller private debt lenders go down, it's potentially a good thing for the bigger lenders. So do you think that could be an area of concern in the next 5 to 10 years?
No.
Thank you.
Let me go into that just a little. Here's something you hear about Dodd-Frank all the time, which is a criticism that's lodged against it. You hear that Dodd-Frank is evil because it's preventing banks from lending, and therefore we have to get rid of Dodd-Frank. That's repeated in the press every other day. It's a great theory. There's only one problem with it. It's a crock of shit. It's a technical term, my word. So let me explain why. It is definitely true that it is harder to get a mortgage loan in the United States than it was years ago. Of course, that's not a Dodd-Frank issue. That's a fact that JP Morgan got fined $25 billion issue and doesn't want to get fined again. So mortgage underwriting is tight and will probably stay tight for years. It's also true that it's hard to get a small business loan in the United States. But there's a reason for that. Banks are not venture capitalists. So when a small business owner goes to a bank for a loan, the first question the bank asks is, what's your collateral? And pre-crisis, the answer to that question was, my house. Most small business lending in the United States was really hidden home equity lending. So since it's harder to get a mortgage, it's harder to get a small business loan. But that's not a Dodd-Frank issue, that's a mortgage issue. With respect to everything else, I don't think the banks are not lending because credit spreads are tight everywhere you go. So how is it possible that the supply of a product has been reduced and the price has gone down? So I think this whole thing about how, yeah, there's more lending by non-banks, so what? They're still not that big. I don't see it as a problem. Next question.
Question over here.
Yeah.
Hey,
Yes.
Steve. Do you think that the oligopolistic rating agency structure and the incentives that those guys have, paired with the reliance of financial markets on those agencies, creates the stage for another crisis, maybe with a different product?
Well, I think the rating agencies were obviously very much at fault for what happened. You know, they were paid 3 to 5 times more for securitized products than they were for straight debt. So they had an incentive to keep that product going, even though the product was very bad. Yeah, I don't think anything has really changed structurally with respect to the rating agencies, but for various reasons, there's just so much less securitized product being created that the opportunities for mendacity have been reduced enormously. So but I don't see anything on the horizon that I'm particularly worried about with respect to the rating agencies, at least not yet. Yeah.
Hi, Steve.
Yeah.
Thanks a lot for coming to Ottawa. Appreciate the opportunity to hear you here. Can you talk a little bit about what you do now in your day job and whether or not you might see that we are now in Act 1 or 2 and therefore see value in financial stocks?
Sure. So I closed my last hedge fund in 2014. I used to just do financials. I decided that was no longer a viable strategy, and I wanted to do all sectors. So I came to Neuberger Berman. It's a wonderful company, and I've been basically studying for 3 years all other sectors. And I've created, at the end of the year, a new product, which is kind of like a hedge fund, but not exactly. So it's a separately managed account, managed like a hedge fund, long, short, but it's all sectors. But because it's a separately managed account, there's 100% transparency, there's daily liquidity, and the fee is only 1.25% flat, no carry. It's the best game in town. You should all invest with me. I actually have this great tagline that I've been trying to get Neuberger's legal department to allow me to put in my presentation, but for some reason they won't let me. And the tagline is, world-class product at less than a quarter of the price. You'd be a schmuck not to invest. And for some reason, the legal department won't let me put that on the presentation. It's really very upsetting. Could you just repeat the last part of your question?
Thanks a lot for the product pitch, but I was really looking for where do you see value now?
So value, I see value ironically, I mean, there's a lot of value in different places, but in the sector that I think has the most value is actually the financial sector. For, you know, given what I said in the speech, what I think, so I'll just give you some very simple math. So today, Citigroup's, this is just an example. I mean, you could name a different company, I would give you different math, but we'd end up in the sort of the same place. So today, Citigroup's return on assets is around 80 basis points, and it's levered 10 to 1. So ROE equals ROA times leverage. So 80 basis points times 10 is an ROE of 8%. So what I think is going to happen is, you know, make rates go up some more. The Fed will definitely raise rates. Reinterpret the Volcker rule, maybe change the tax code, and in a year or so, or 2 years, the ROA will go from, let's say, 80 basis points to 100 basis points. And over the next 4 years, the leverage will go from 10 times maybe to 14 times. So the ROE will go from 8% to 14%. That's a big jump. You know, I don't think there's any sector in the S&P that has the potential for that kind of jump in return. And so, you know, where I think the sector for the next several years has the most potential for return is in the financial sector. like I said, you should all invest with me, and I'll be handing out cards at the end of the evening. Anything else? I'm happy to take. Do I see that happening in Canada too? No way, man. No way. No, I mean, your banks are oligopolies. They're already quite profitable. I don't see them getting more profitable. So, no, you don't have that potential.
Do you have any view on Fannie Mae and Freddie Mac and
Do I have any view? Yes, I do have a view on
like
Fannie.
on the recap and release or any opportunity on the press or the common?
I do. So for those of you who don't know the whole story, I'll tell the story. It's kind of a very interesting story. So Secretary Paulson decided that Fannie and Freddie were done, and he took them over. He did not put them into receivership. He put them into what's called conservatorship, which is this technical legal term, which means basically conserve the capital. The original deal that was struck was that the government gave Fannie and Freddie some God knows how much money, and Fannie and Freddie were supposed to pay a 10% dividend on that money. So between the time this happened in 2008 and 2012, Fannie Mae lost money every single quarter. So they couldn't pay the 10% dividend, so every quarter we went to this charade of Treasury would send Fannie Mae more money, and then Fannie Mae would send it back. And that would be how they paid the dividend. This was kind of ridiculous, Treasury said, and so in 2012, Treasury said, you know, we're changing the deal. And they unilaterally changed the deal, and they said, you know what, forget about the 10% dividend. We'll just wait. God willing, one day you'll make money, and whatever you make, just send it to us. And that was the deal. And wouldn't you know it, 2 quarters later, Fannie Mae made money. And so they've been cutting checks to the government every quarter since. Some of the shareholders thought this was not so kosher, and they sued the government, and there is a thought out there that there was a meeting between the CFO of Fannie Mae and the Treasury Department just before this deal was changed, where the CFO supposedly told the government that Fannie Mae is about to go profitable. And the government said, great, let's change this deal. And so that may come out upon discovery very soon in these lawsuits. You know, I think under the new administration, there will be an attempt to recapitalize Fannie and Freddie. I don't know if it's going to be successful or not. My thought as to what will push this forward is if there is real tax reform in the United States, you know, Fannie and Freddie have enormous deferred tax assets. And if the tax rate is lowered significantly, that will mean that Fannie and Freddie will have to take a big write-off. And when there's a big write-off, instead of the government getting a check from Fannie and Freddie, they may have to write a check for $20 billion to both of them. And on that day, the government will say, you know what, maybe we should restructure this deal. And so that's what I think will eventually happen. Yeah.
Just wondering if you see any similarities between what happened in the States and potentially what's happened in Canada. Canadian
In housing?
market, obviously Vancouver and Toronto, red hot,
Sure.
going up really high. Wondering if you have any perspective there.
So I had a bet with myself, $50, that would be the first question. I lost
Do I get the $50?
to myself, but I'll keep the money. Thank you. So I predicted the demise of the housing market in Canada in 2013. That didn't work out so well for me. There's some significant differences in what is going on here than in the United States. I don't think you've really had a subprime market. I mean, I think your underwriting standards have certainly gotten weaker, but they haven't been devastated. So, I mean, I do believe you have a bubble, but that bubble, I think, is a lot more tied to what's going to go on in your economy than what happened in the US, where the underwriting got so bad that the housing market just imploded upon itself. So I think you saw some signs of that about a year and a half ago when oil got to 26 and your banks reported you could see for the first time there were going to be credit problems. And then, of course, oil went right back up and your economy came back and the credit problems went away. So if there's going to be a bursting of the bubble in Canada, it's going to be tied to when your economy, whenever it rolls over. I mean, one day Canada's economy will roll over like any economy, but I'm not any better at predicting that than anybody else. I was humbled. Yes, anything else? Yeah. Has any senior member of the new administration called me? No.
How would you characterize the major risks with this new administration?
How would I characterize the risks of this new administration? I'll be very careful in answering that. Someone could be listening. I mean, look, obviously healthcare reform didn't go so well. I think this entire administration is now resting on whether there's going to be tax reform. If they get tax reform, I think you'll see a pickup in the U.S. economy, and people will start to say maybe they're doing a good job. If there's no tax reform, I don't know what they're going to do. So I think that's their biggest risk, is whether they get tax reform done or not. Yeah.
Hi. You talked about your what you see as a positive outlook on the financials. What would you see as the best investment from the short side right now?
What's the best in the short side? Well, if you were an investor, I would really share that with you. What's the best? Well, I was short Granger. That was down 11.5% today, so that was good. I think there are some issues emerging in subprime auto. Excuse me. I don't think it's a calamity, but there are a few companies that are involved in subprime auto, which I think are interesting shorts, and we could have a conversation later about more. Yes. You mean like in the United States government? No. Let me elaborate. Sometimes these one-word answers don't go over so well. I'll focus on the U.S. just first. So I'm not a deficit fetishist. I made up that word. It's a pretty good slogan. Debt to GDP, the government debt to GDP in the United States is about 105%. In Japan, it's 240. So, my view of people who say the deficit, for example, is a problem in the United States is that they've been making that argument for 30 years, and all that's happened is rates have gone down. So maybe they're right, but when you make the same argument for 30 years and it hasn't happened yet, I think the onus is on you to come up with a new reason as to why it's a problem now. So it's not something I particularly focus on, rightly or wrongly.
Would you say these low interest rates have caused major dislocations in investments in the U.S.?
Question is, would I say that these low interest rates have caused major investment dislocations in the U.S.? Yes. Now I'll elaborate. So, when you think about what we do for a living, really, we allocate capital. And when you think about how do you allocate capital, at least in principle, you're supposed to do a DCF on every company or industry and come up with a value and compare that to the current value, and that should decide whether you invest or not. So the problem is that when you're doing a DCF, at least in principle today, and rates are zero, what's your terminal value? There isn't one. So in a zero-rate world, it becomes extremely difficult to figure out how to allocate capital. And so I do believe that largely because of that, there are dislocations. And the other thing I believe is that the Fed's QE2 and QE3 has been a failure, that it has absolutely no impact on the real economy, that all it has really done is give companies money to buy back their stock, that they haven't actually invested in the real economy. Now, maybe if we go into a world where rates start to go up, that will change. But in some ways, counterintuitively, very low rates has been counterproductive for the real economy. I like to call QE2 and QE3 monetary policy for rich people. That was kind of funny. You could have laughed at that, but I stuck that one in. Yeah. Am I worried? Everybody always asks me about that. You know, I did the Big Short. I'm not in any rush to do it again. I'm really not. I do think there are dislocations, but I'm not worried because, leverage in the financial system, at least in the U.S., is just so much lower. That doesn't mean they can't be problems. They're just not systemic. So I'm a little worried. I'm not that worried. I sleep fine. Am I bullish on any specific country? I'm kind of bullish on the U.S. right now. I'll talk to you about Europe after the French elections. Call me in a week. Or Monday. Anyone else? I'm here. I'm yours. No good? We're all good? All right, thank you very much.